saw a George Gammon video today, and this is a really good point. Going back before the inflation, we had spent a lot of time, looking at the velocity of money. And what we had seen is that, this is a huge long-term chart, and I have both the M1 and the M2, and I'll explain the difference in a little bit. We'll look it up. But the point is that this has been historically low for a long time. Now, the velocity of money, it's supposed to, and this is really the question, it's supposed to have an effect on inflation. So the idea is if I have a dollar and I buy something with it, that's a velocity of 1 as a reference, right? But then if that other person just holds that dollar, that it's a velocity of 1. But now if I buy something from someone and give them a dollar, and then they take $8 and they buy something else, and then that person buys something else, and that'd be a velocity of 3. So the point is how fast the money is circulating in the system is a factor for inflation, or it's supposed to be a factor for inflation. And the idea would be, even if you had, let's see, $1 trillion, and all you have is $1 trillion out there, and that $1 trillion is floating around at a rate of 2, 3, 4x, very high velocity numbers, you can imagine that would cause the price of things to go up. So as an example, let's say, even though you have a small amount of money, the fact is that, if one person spends the money, gives it to another who spends it, then goes back, et cetera, it can create this effect of, more money than maybe there actually is. It's essentially can become a money multiplier. So what we see, which is really interesting here. So I'm going back way in time, in the M1, M2, you can see here, okay, what's the difference between M1 and M2. So we just look it up. So M1 includes monies that are very liquid. So this is your cash, checking, deposit, traveler's checks. So this is the true real cash. And this is what just most people have. Now, M2 is less liquid because it includes things like savings and time deposits and CDs. So for example, if you had like $1,000 in your checking account, the $1,000 would be, counted as M1 money. If you had an additional $5,000 in a CD that you can't get to for a year, you have to let it sit there for a year, then altogether your M2 supply would be that 5,000 plus the 1,000. So the point is, it's a wider dimension. Now, it includes more of the types of money. And then you can go to M3 and other measures, and you can study that in economics. But the idea would be even, you would consider things like loans and other stuff like that, and other things would be part of maybe M3 or something like that. So what's interesting here is that so you have to take this relative. I'm taking, because they're on different scales. So I'm multiplying M2 by 2. So just keep that in mind. But the point is, we're just looking relative. So you see that the M1 stock was increasing in the 60s and 70s up to the 80, and then it dropped. So the point is, we had high inflation in the 70s, and look at that M1 increase. Now, what's really deceptive is look at M2. M2 is not going up that much. So if you were just to look at the chart of M2, which would include these savings and less liquid things, you would think, well, the money supply is not going up, but yet we had a high inflation in the 70s. As a matter of fact, the current numbers that we have, the highest numbers of inflation going back to the 80s and 70s, that's kind of where we're at. So, but now looking at this, it can start to make sense. You can see that the M1 money supply increased greatly. And then it finally broke during the recession. And this was the point in the 80s where basically, if you go back there, it was like Volcker basically pulled the rug out on us, right? Basically increased rates to horrendous rates to get actual positive real rates. And so what's interesting, is that the M2 didn't move much, but M1 moved a lot. So this makes a little more sense. We had high inflation, increasing inflation, finally broke it. And then the M1 comes down. Now, what's interesting, you see you have some M1 increasing there, et cetera, et cetera. Now it's really interesting, though, because why did the M1, it's gone up a lot into 2000, but we haven't had high inflation. And that's for sure something that I can't explain. And a matter of fact, from this point of the mid 90s, you see the M2 is kind of starting to decline, and yet M1 increases a lot. And we didn't really have much in the way of inflation. We really didn't have much inflation back here. I mean, until more recently. And then we have the money supply just drops off a cliff. So if we kind of zoom in, we can see that both these just drop through the floor, and these are at very low points. The um, the velocity is very low, and if you go back to like a couple of years ago before all this inflation, you would listen to the Fed and they'd be talking, they're trying, we can't get our 2% inflation target. We're struggling to get it because the velocity of money's low, blah, 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 blah. And it was just a really struggle for them. And now it's interesting, after all that time, after all the money they printed, the velocity has just dropped even more. So what does that mean? As far as I can tell, and so this is where, we're speculating. So let's use thought experiments. So if the velocity is down, that means people are hoarding it. And so we saw this, I know that some people are reporting that there's still very large balances in people's savings and checking accounts, and that could explain why this money velocity is so low. But now that's where we're at. All right, the velocity is low, but here's the thing: what is the consequence of this? See, we have a really low velocity right now, and the Fed is cranking interest rates up, trying to get rid of this inflation. We have a weird thing. We have really, really low velocity, but yet high inflation. So does that mean there's no correlation there? Well, maybe, or it means that there's a big problem. In other words, if this velocity starts cranking up, if this inflation persists much longer and people start actually increasing the velocity. So look at it this way. This is how it works. Let's say if you get your paycheck and you have some money and you're like, well, and you're one of these Costco people, and you go to Costco once a week and you buy stuff. And, anyone that's been at Costco, you always buy too much food, you buy bulk, whatever. But now you can imagine this as a metaphor. Now you can imagine like, gee, the price of everything is still going way up. And you can imagine that people might be, well, screw it then. Let's go to Costco and we're going to eat these Maruchan noodle soups and stuff. So let's just buy more and buy more now while we have the money. So you can have this kind of an interesting situation that you wonder if this is what's coming. So we have the issue of the high inflation, the Fed increasing rates to try to drop off demand, but we still have a lot of demand because the inflation has not gone down. And this is then worrying, because the worrying part is if consumers, or enough of them, are not buying the inflation story right now, if enough of these people have not acknowledge that, wow, this inflation that high. I mean, a lot of people getting pinched, a lot of people unhappy with high gas prices, whatever, food prices, whatever, but are they acting yet? And that's the question. So at some point, if this turns into a little more Weimar like, where people are like, look, I get my check, I immediately do all my shopping that I need, and anything I think I might need, try to spend that money as soon as possible. And if that starts happening, and you could imagine a situation, what happens if the velocity, so if you take the M1 velocities at 1.1, it was at 5, right? The M1 was at 5 only a few years ago. So if we go from where we are all the way up to 5, I mean, what is that going to do to inflation? Now, if it turns out that there's no correlation between money velocity and inflation, if there isn't a relationship there, then it means nothing. But if there is a relationship there, or this relationship that may be broken, that sometimes sometimes things work is a relationship is together, dollar down, gold up, and then sometimes they both go up and sometimes they both go down. So sometimes relationships get broken for a while for a variety of reasons. And then the question is, so that's what I'm trying to get to. That's what I'm concerned about, is if the velocity picks up and the relationship between velocity causes increasing inflation, that could really be a tough one. Because think about it. If, the Fed's cranking things up, trying to get demand down, but then the velocity picks up. And that's an interesting one because, if even without more money, if the velocity goes up, it effectively acts like more money. acts as if there's more money there. And so that would be the risk here, is that if the velocity starts picking up, then maybe the Fed otherwise would have successfully killed off the demand, but then the velocity picks up because people are like, well, I'm going to buy now to avoid the inflation that they think is coming. And if that starts happening, that will make the inflation actually worse. So that's kind of an interesting thing there. And yeah, I picked it up from George Gammon. So that's really interesting. So that's all I have for this one. Talk to you later. Bye.